Good afternoon, everyone. Let me just check. Nanette, did we hear from Norm Roldan, if he was able to join us?
Yes, he's a yes, but I'm just calling him right now and left him a message. He was a yes, and I sent him a reminder.
Okay. Mike Chase, good afternoon. Good to see you. I was reading your body language. I wasn't sure if that was the $1,000 drop in the Dow today.
We were just talking right before you jumped on. We were talking about that. It's been a wild couple of days.
Yeah, we do have our board chair, Mary Kate Murrin, is on here, so we can certainly give it a couple minutes before maybe jumping into things, if you all don't mind.
Sure, that's fine.
Great.
Yeah, Mike had a furrowed brow. We all.
While we're waiting, you've probably noticed a new face on the screen. So Matt Fertini is a member of our team here at Fiducian. He's been with us for probably 7 years now, right, Matt? Works as one of our senior analysts and as a consultant. And he actually is native to the Springfield area and is, I think, still there today. I'm not sure where he is today, but that's where he usually is anyway. So Matt's going to just be another member of the team going forward. So I'll ask him to participate in some of these meetings, and he'll interact with Andrea and John and I, on some of the day-to-day stuff back and forth. But I just wanted to introduce him, and just so no one was kind of questioning who the new guy was on the screen.
Appreciate that. Thank you.
We'll blame him for the 1,000-point drop. Welcome, Matt.
Thank you very much.
Well, let's get going. I want to respect everyone's time, including mine. I can call to order the Springfield Technical Community College Investment Subcommittee meeting of Thursday, May 5th, 2022. Mary Kate Murrin, present. Okay.
Thank you. With that, Mike, we'll turn it over to you. By way of orientation for Matt, you'll see Tony Montemagni on here. So we sort of build especially for our investment committee, a group of people both within the college and outside the college. Tony, let me give you a chance to provide an introduction. But Matt, again, Mike Chase will probably share with you. We've got our leadership team from the college. I'm the president here. I've been here 6 years. We've got Andrew Nathanson, our CFO. We've got John Trudrin, our controller. We've got Dorothy Unger, also from our admin and finance team. Nanette Flores is executive assistant to the president, but also clerk to the board of trustees. So we've got a good group here that really is the sort of brain trust for this. Again, we've got a wonderful relationship with Fiducian now for a number of years, given the acquisition work, and we've really been really happy. I think as a college, I know the board of trustees really have been thoughtful when they put this into action. I think in 2015 to be a lot more intentional with investments. So, Tony, do you mind just giving an introduction to, just so everybody knows?
Sure. Yeah. Tony Montemagni from UBS Financial Services. My office is Also in Springfield, Senior Vice President at UBS, Wealth Advisor, 25 years experience working with high net worth and ultra high net worth clients primarily, but also working with some institutional clients. And a lot of what I do is some of what Mike does as well in terms of investment reviews and monitoring fund investment managers in different asset categories.
So we typically, again, Matt, and then I'll turn over to Mike. We typically have a board of trustee who is like the designee for this. We're fortunate that our board chair tends to come to every meeting. Thank you, Mary Kate. Norm Roldan, who will make sure we get a sidebar with for you and Mike, is that liaison. He also serves on the college's Ways and Means committee, which is like that budget and finance committee. So with that orientation, Mike, we'll turn it over to you and ask you to look in your crystal ball and tell us what is going on out there.
Sure. So I'll continue to drive most of the ship. Matt will jump in from time to time as well. But before we jump in, I just wanted to say congratulations on the big news about the state grant on Building 20. So that's exciting. I know that means we have some work to do in terms of the investments in the last couple of days. Probably not the friendliest time to be talking about that, but we still got a little ways to go. And but that's great news. So glad to see that came to fruition after all that planning. So with that, we'll jump right into it. Just one quick plug for us. We are going to do our client conference this year in person. We took a 2-year hiatus with all the COVID stuff, but that's going to be in Newport next month. So if anyone's able to join us down there, it'd be great to have anyone attend. So, and we're also going to do one out in Chicago this fall as well. From a governance perspective, we can go quickly this quarter because it doesn't apply a ton to these pools. This is the quarter we typically dig into just spending policy trends and some analytical work around that and dig into the fees, because that long-term pool, right, isn't a true endowment. It's really just there as a long-term investment pool with occasional capital draws to fund capital projects like that Building 20 project. You know, some of this stuff doesn't really come into play in terms of more consistent draw like a traditional endowment. So we can skip over this high level. I would just say, one thing to note is, we've touched on this with clients for quite a while, but, the stereotypical kind of 5% spending level that most endowments had enjoyed over time, that's really moved down to 4.5% or 4%. We've actually seen that since 1990, a 5% rate has been not sustainable in terms of maintaining the purchasing power of that original corpus pool over time. And is a big reason why we've seen nonprofits start to shift their spending down gradually, is not to impact the operating side, which is really dependent on it, but we've seen that trend. So just one point there. I think we can skip over the rest. It's obviously been, we'll touch on the markets, but it's been a pretty crazy time in the world. We have a lot of content out as a result of everything that's going on, whether it's the Fed, Russia-Ukraine conflict, you name it, all that stuff is listed on the website. So hopefully everyone's getting those emails. But in addition to that, you can always find it on the website, and actually in the report, if you just click on the links, it'll bring you right there as well. And then lastly, from a fee structure standpoint, again, this is in the books every quarter, but just to put it front and center, the total fee or cost load for the program, the long-term pool, the underlying management fees are about 50 basis points. The short-term pool, they're 17 basis points. Principal, which was formerly Wells Fargo, that's their custody charge there. And then our fee is listed here as well. So just to give you the full kind of analysis of what the fees look like, I would say, for a traditional endowment portfolio, these are quite low from a management fee side. And we were able to push them down a little bit, just given our buying power with the managers that we're allocating to, and get you the lowest share classes that you may not be able to get on your own. And then, a combination of active and passive management as well, what kind of drives that fee down pretty notably. Any questions on, I know I went over that quickly, but any questions on the governance materials and specifically the fee page? Okay. So just digging into the capital markets, obviously first quarter was a difficult one. Quarter to date has not really been any better. The primary drivers are these inflationary pressures that we're experiencing and ultimately what the Fed's reaction to that is. We saw the Fed raise rates 25 basis points last month and then 50 basis points yesterday, and kind of foretelling that they expect another 3 to 4 rate hikes through the rest of the calendar year. So trying to get ahead of those inflationary pressures. Obviously, when interest rates go up, fixed income prices go down. They act opposite of one another. So we saw a pretty difficult market environment. Actually, only 16 times in history has the S&P 500 and the Barclays Aggregate Bond Index been negative in the same quarter. Typically, we'd expect them to really be kind of contrarian to one another. So really not a lot of places to hide, which made it a very difficult place to invest. And even on the shorter end of the yield curve, which is what the Fed controls explicitly, you'll see in the short-term pool that we weren't able to escape negative price pressures as well. We were able to offset it a little bit, but not escape it entirely. The Russia-Ukraine crisis, the kind of two primary things from that. Number one is just the impact on commodity prices. Commodity prices shot up dramatically as a result. That's really the biggest input that Russia has on the global economy. They make up a very small, they don't make up any portion anymore, but they made up a very small portion of the investable opportunity set. 4% of the emerging market index at the end of the calendar year. But they still kind of obviously are having an impact on the global economic picture. GDP numbers were revised downward. We actually saw a negative GDP print for the first quarter here in the US, which caught everyone off guard a little bit. Actually, the market shrugged that off surprisingly well, given that it was somewhat unexpected. Maybe it was foretold a little bit because one of the things with rising rates, especially on the short end of the curve, we look at the inversion of the yield curve. So what that means is that you're getting paid a higher coupon to own treasuries that are shorter in duration than you are the longer in duration, and that's atypical. So basically what it's saying is that the market's predicting a recessionary environment. The 2 to 10 year inverted yield curve has been a leading indicator for every recession that we've had here in the US. So that did happen. Actually, it was basically flat on March 31st. It did happen very early on in April. It's since receded a little bit. It doesn't mean that it's kind of an end-all scenario. In fact, we ran some historical numbers on this, and the year after that phenomenon occurs, the capital markets actually tend to hold in okay, and you really don't see an inflationary environment really start to take hold on average until about 2 years. There's quite a bit of dispersion here. Although with that negative US GDP print, technically a recession is defined by 2 negative GDP quarters. So for some reason, we were able to have that kind of roll forward into quarter 2. Technically, we'd be in a recessionary environment right now. So kind of a lot to see how that plays out. This is what the yield curve looks like at the end of the year. Again, this is continuing to shift up with the Fed's recent expectations. The market controls the longer end of the curve, generally tries to foreshadow the expectations. We think a lot of the shifts in the longer end of the curve has been priced in to an extent. We also saw spreads gap out pretty dramatically. So a pretty choppy environment for fixed income, right? You don't rarely see fixed income returns in over a short-term period this negative. The ag was down about 6%, high yield down about 5%, non-dollar bonds generally a little bit worse because the dollar was strong, and then the longer end of the yield curve down pretty notably. Essentially, fixed income was down right in line with the same magnitude as the equity side. Again, pretty rare to see that. The S&P down 5.1, EFA down 6, emerging markets down 7. Really, the only bright spots were in diversifying asset classes. So commodities and real assets did quite well. We'd expect them to, given they respond in inflationary environments. The reason we've had them in the portfolio is for exactly that. So we were rewarded for keeping that strategic allocation. So that was very positive. And then marketable alternatives or hedge funds actually held in there pretty well in addition to that. So we benefited from that exposure as well. On the equity side, valuations overseas have moved back to longer term averages where they still look a little bit stretched here in the US. The other thing, it was just a huge period of dispersion amongst industry returns, sector returns, individual company returns. The market has all of a sudden really focused in on earnings. We've seen the impact of that, right? Netflix missing earnings and selling off, 30% in one day. It's pretty wild. And if you look at what drove markets, energy up 40%, utilities up 5%. So it was definitely a value-oriented quarter. Growth managers really struggled. But I'd say that most active value managers actually didn't participate to the same extent because most of them were generally underweight energy and don't hold utilities. So it was a pretty tough environment for active management. As a result, we'll dig into that here in a minute in the portfolios. Any questions I can answer on the markets before we flip it over until the impact on the long-term pool and the short-term pool?
Mike, why didn't you just put us all in commodities?
Well, if I did that 5 years ago, Tony, you'd be telling me I was the dumbest person alive for the last 5 years, right? I think a good example of a longer-term pool of capital being able to be more strategic, own some more diversifying asset classes, staying committed to that exposure, and eventually being rewarded for it, not trying to time the markets too cute. Because it's, growth equity here in the U.S., which has been the poster child, right, for the last decade, has had a pretty quick falling from grace. So we did have meaningful exposure. We didn't bet the ranch on it, but definitely had a positive return from it here in this environment. I think one thing to actually, Tony, it's kind of, I know you're smirking, but it's kind of interesting to note here, right? If you look at the commodity returns, up 49% on a 1-year basis, roll that out 10 years, it's annualized at negative 70 basis points over the last decade, even with that 1-year number. So, okay. So one thing to touch on, we did wrap up the dollar cost average program for that 10 million contribution that came in, right? It would have been nice to avoid a little bit more of this downturn, but we did avoid a good chunk of it with a chunk of that money as we gradually put it into work. And again, it's longer term money. So I think a thoughtful way to do it. The last investment went in beginning of April. So now you'll see reflected in this report, there was one more $1 million shift that's not reflected here that happened in April, but that has been done and I think settled out in the right place. And we can certainly have the conversation either today or with Andrea and John offline about planning around building 20, how much we want in the short-term pool, et cetera. But we've kind of settled out on those initial target numbers. The other thing we rolled out, and I told you about it last meeting, is we did update the performance reports a little bit. It's still the same systems, the same key data, but we added a couple of new things. This page is really more focused on a true endowment with a spending rate, but we put it in here nonetheless because it's supposed to take just a bigger picture view than relative performance or absolute performance in a short-term period. So what we did here was take basically the growth of $1,000 based on the returns of the long-term pool and then the returns of CPI. So this is really just showing you that since 2014 and fall of 2014, when we started this program, you've meaningfully added to the purchasing power of that longer term pool, which was exactly the goal. CPI has been pretty benign, but it's kind of risen to about 1.2 million, and this was up to 1.6. So kind of achieving that longer term strategy. From an allocation standpoint, we're pretty tight to targets, just a little bit underweight fixed income, which we've done purposefully given the expectation for rates, a little bit overweight on the equity side, basically right in line from a market alternative standpoint. We ended the March at just shy of 22 million, right? So obviously some contributions into this pool, but also some appreciation, not this quarter, but over time, it's been pretty substantial. You can see the underlying manager results or allocations here as well. They're pretty tight. And one of the reasons we're so tight is that we've used these $1 million cash flows, right, to just rebalance the portfolio anytime that cash has come in. So for the quarter, the portfolio held in quite well, as I mentioned, down about 4%. So negative from an absolute standpoint, but relative to the benchmark, about 80 basis points ahead. So protecting in this type of environment. And the relative performance continues to look pretty strong. That's been a combination of kind of timing of cash flows, which has been positive, and then the active managers contributing to value as well, which we always want to see. Digging in a little bit deeper, I don't know, Matt, if you want to touch on all this, we don't have to go through some of the managers, but just hit a couple of high levels.
Yeah, perfect. Thank you, and good afternoon, everyone. Just looking at the fixed income composites, it's right at the top third of the page there. It's the shadowed line, the blue font. You can look at the quarter to date number. It's down 4.8% versus the benchmark, which was down 5.9%. So nice outperformance there by about 1.1%. And that's driven primarily from BlackRock, your unconstrained manager, and also Brandywine, the global bond manager. Both of those managers had really nice quarters, and also those transitioned into the 1-year number for both of them as well. Similar story for both those managers. As Mike mentioned, we saw a rise in interest rates. Both their stances were shorter duration than their benchmarks, so that was a tailwind for both those strategies. Looking at fixed income, you'll see a similar theme here, that we saw some nice outperformance for the quarter by about 50 basis points, and then also on the 1-year, outperforming the benchmark by about 80 basis points. Diamond Hill did struggle on the 1-year, and as Mike mentioned his comments on the market, a lot of our active value managers did not participate all the way due to them lacking ownership within utilities and energy. That's exactly what happened here for Diamond Hill. But as you look at their longer term numbers, you can see how strong they have been. They're a top percentile manager across all time frames from 3 years onward. And so they really are a strong active management here in value. And then looking at both the large cap and mid cap exposure here is index. So if we went right down to the small cap exposure, you can really see that dispersion between value and growth, as Mike mentioned. Just looking at the Boston Partners for the quarter, down 2.3% in line with benchmark. When you look at Conestoga, down 15.3% versus their benchmark return of 12.6. I mean, that's a 1,200 or 1,000 basis point swing there just between those two asset classes. And this was an opposite story. If we're talking a year ago, growth was outperformed by that margin. So really quick reversal there. But within Conestoga, their underperformance is really just due to an overweight position in healthcare and also technology. But when you look at their numbers longer term, you can see on the 1-year, they're 1,000 points ahead on their benchmark. And then also if we look to the 3 and 5 year, you can see up 3% and up 5% over their benchmark. So really strong performance there as well. Now, international markets, as Mike mentioned earlier, has been very choppy. There's been a lot of volatility overseas. So looking at MFS just for the quarter, trailed its benchmark by 2%. That's just due to an overweight position in Europe, which we saw a lot of volatility in with the Ukrainian invasion by Russia. But once again, longer term numbers, very well intact, top decile across the board. And then as Mike mentioned, looking at the real asset section, the principal diversified real asset manager, Mike's got his cursor on it right now. You can see it was actually positive for the quarter, up 5.7%. And on that 1-year number, up 19.1%. So really nice performance there for the portfolio in this inflationary environment that we've seen. And then just to round out my comments, looking at the marketable alternatives, Ironwood is the new hedge fund manager that was brought into the program in November. So you can see here, looking at the quarter number, down 0.1% versus their benchmark, that was down 2.6%. So bringing that diversifying return stream and also it being a risk mitigator has really been beneficial, because when you look at it in a broader spectrum, the S&P 500 for the quarter was down 4.6%, and the ag was down 5.9%. So with this essentially being flat for the quarter, Ironwood did a very nice job overall, and is definitely earning its keep for the quarter and for the last 4 months that it's been in the program. Any questions for the long-term portfolio?
I would just conclude that, obviously we're active on the manager side if necessary, but, comfortable with everyone, not planning to make any changes to the current manager lineup. Matt mentioned the fixed income side, right? It's been a pretty dynamic approach we've talked about, right? Shorter duration, pretty flexible with the mandates we're using. We're not there yet, but we are starting to have the conversations internally about what does kind of the yield on the ag or the 10-year need to get to for us to start to pull off some of those tilts a little bit and make the portfolio a little bit more kind of core traditional fixed income looking. So just to kind of foreshadow some of the conversations we're having internally, but not kind of there yet in terms of making those adjustments. And then I'll just quickly look at the short-term side of things. Similar story as I mentioned, right, with the rise in rates, even though this is a short-term oriented portfolio, not able to avoid the downward pressure in fixed income, but we did mitigate it to an extent, down 1.5 versus down 2 for the benchmark. And that's really the result of some of the managers. Just flipping forward to that, you can see the protection here. Payden down was only about 60 basis points down. Vanguard short, so that was really where most of it came from. Vanguard short term right in line with its benchmark, and then TIA, which we have in there from a social perspective, that's going to have the longest duration profile. So that's why that one looks, particularly noteworthy from a negative standpoint, because it's more of a true core holding. We also have a good chunk in the MMDT money market. We should start to see money market returns now that the short end of the curve and the Fed funds rate is at 50 to 75 basis points. We should start to see a positive return starting to come from money markets, which we haven't seen for quite some time. So, right, we do have a negative in the near term because of the price impact, but it does mean that on future returns and coupon payments we're going to start to get are going to become a lot more meaningful, and we're getting closer to potentially generating a positive real return from a fixed income oriented capital pool. So that ended the quarter about 6.8 million. Fast forward to end of April, that's down to about 5.8 million with the result of that last million that was transferred over. So that was everything that I had prepared from just an investment update, but happy to comment on anything portfolio related or anything strategy related that we can offer any guidance on.
Yeah, I know Dr. Cook will definitely jump in, Mike, as we celebrate what we got from the state, right? That money and potentially another 5, having some cash available for overages, right? Change orders, Dr. Cook, right? Increases in prevailing wage and all that. I think we need to really kind of, Mike, talk about strategy on timing. And I think we're not really going to do anything until next school year. Is that right, Dr. Cook?
Yeah, I'll give an overview, Mary Kate, too, of that. Yeah, so I guess just a couple of things. As far as the portfolio, Mike, good to see, thorough as always, really well appreciated. I don't have the kind of insight that a Max Starkis has. Obviously, he's been a great trustee for us with his questions and perspective on all this. I will say, I tend to always look, Mike, at that TIA CREF. Obviously we put that in place. It's good to have a social position. Maybe those bonds are going to kick in this market eventually to give us some further value there, but I can't help, of course, but look at that. But I'm glad to see how we walk through the sort of move from cash to investment in that strategy. Good to have seen that through. And I believe our true cash position is still very strong. And I know we talk about that. I see John Tudrin, our controller, nodding to that. So we are obviously beyond these investments and this money and under investment, Mary Kate. We've got a separate in the bank, a TD bank kind of account with a lot of cash there too. So we're really in good shape. So again, Mike, thank you. It's really helpful to have. And obviously we have a lot more money that we have currently in the bank there so that we can actually build out this longer term approach with like an infrastructure project. So to that, two points I just wanted to be sure, Mike, that you and your team had today. One is we are close, and this month we are expecting our trustees to approve the fiscal year 23 budget. And as has been our relatively new practice, we don't have any investment revenue in that budget. And again, we will continue to likely take that approach. So this is truly investment. I think we've really worked hard to preserve the position of the portfolio this way, where we do not treat it as a revenue source, and we'll continue to do that. So just know that we're not trying to pull anything out here for operational function. The second thing then is, yes, so we were awarded this major capital project money from the Commonwealth. That's a very big deal, of course, for us. We're probably going to be closer to last dollar on that. So we may be 2 years away, quite frankly, from any kind of divestment. So just know how long a runway we will have. It's certainly not in the next 6 months. We are meeting with DCAM right? DCAM is the Division of Capital Asset Management and Maintenance. That's the state agency. And they actually serve as project manager for this. The college itself, given the size of this and given our relationship with Massachusetts, we don't even project manage this ourselves. The state will do that. So we'll go through their design build process, procurement obligation, all that will be done by the Commonwealth of Mass. So again, we've got to architect this, and that's got to go through a design process and an RFP process. And then they're going to scope that work, and then you get a contractor in. So we now have to play that game, dare I say, of how long it will take for this, and then the dollars, how they flow there. So we're some time away from that. Again, every month in that these dollars remain investment, even in a volatile market, is the better for our investment position. So we'll take it as long as we can get it. What I like is that we have built out a multi-year approach where we show our trustees in particular how we do the divestment on this and where we stand at the end of it. Even, by the way, as we need reserves, Mike, otherwise in these incremental ways, separate, I guess I should say, because I realize I'm saying we don't need this money for operational oversight. I should have hedged that to say, not in the sense that we did previously, where there was, I think, revenue via interest that we plugged in there. We've not done that. We obviously know we need help balancing the budget, given where expense and revenue is. And again, we have this multi-year model. I'm assuming our team has shared, Mike, with you. And if not, obviously, John Tudor and Andrew Nathanson can make sure that you see that piece. Because when we step that down, combined with the capital project that is Building 20 in the school health, depending again on the markets, we get to a place that is sort of pre-COVID in terms of that 18 million under investment, give or take. So again, we're real pleased with how we've managed this. Again, with your help, again, I think we've preserved some of the core elements. I just want to be sure we're mirroring that back, Mike, to you, so you know what's the outlook with the college and operations.
Okay, great. Yep. No, John sent me a very detailed note last week, kind of giving the heads up on just plans around divestment for Building 20 and some of the expectations around that, and then also potential other divestment here in the short term. So we'll continue to stay in close contact with him and help think through that.
So happy. I don't know if any of the rest of our team have any questions or comments, but Tony, otherwise, we're always at just real good ship shape, Mike, with these conversations.
Yeah, thank you, Mike.
Okay.
Awesome. Mike, again, thank you. Really appreciate it. My questions aren't going to baffle you like maybe Max were, right? Because as he really was the expert. So really appreciate the time and welcome, Matt. Really appreciate you too. Well, Dr. Cook, we'll just keep an eye on things, right? Delays in the building and all of that, because you know how that can really start to put more pressure.
Yeah.
On the need for cash quickly.
And I'll close that part out. So it's fascinating, the political part, Mike, for this whole thing. So in our funding stack, in last year's economic development bill that was passed by the legislation, there was $5 million earmark as part of the stack, because this is actually a $42 million project on paper right now. $5 million that went in via the delegation and was not line item vetoed by the governor. The governor just filed an economic development bill in the last 2 weeks that actually includes that $5 million. And what this allows is an avenue to bonding for those dollars by the Commonwealth. So we got the 30, and it's looking, again, knock on wood, like we might have that 5 that we had put in our funding stack, but that had less certainty attached to it. So what that does is allow us to not have to go into our own internal contingency approach to how we get to 42 million, to the point of Mary Kate, depending on the longevity of this, depending on the cost of this. Again, the Commonwealth is the official project manager. We'll have to contend with budget later down the line. Whether that is on us or whether that falls on Massachusetts, we'll debate that, because the building behind me, it wasn't like the college had to put extra money in to make that thing go. It was ultimately $50 million. The trustees put in 3 out of reserves. Mike, I think you'll remember some of that divestment work. around 2016, give or take. So again, we'll cross that bridge when we get to it. Obviously, the project today will not cost what the project 2 years from today will. But again, I like our chances. We got the big one. We got the award. We'll figure this out.
Great. Do I need to officially end? Is that
Only just some official salutation that per your order as the acting chair, you've closed the meeting.
great? Ditto. No, again, really, Mike, thank you, Matt, and your entire team. Of course, administration, really, thank you. So I will conclude our investment subcommittee for today. Thank you again so much, everyone. Get outside because it's gorgeous before the rain comes.
Thank you again, everyone.
Take care.